Hello, good afternoon and welcome. My name's Kevin Igo, Managing Director of PFP, and I'd like to welcome each and every one of you today to one of our monthly webinars. Now, today we're going to be covering a subject which is very topical and something that's very much still up in the air with how it's going to work in practice and how it eventually does work in practice. So I'm pleased to be joined today by two experts in the subject of making tax digital. That's Danielle and Richard, Danielle Ford and Richard Hoy from Hayes McIntyre. So if I can just ask you both firstly to introduce yourselves and give the audience a little bit about your background. So Danielle, I'd like to start.
Thank you, Kevin, for the introduction, and welcome everyone to Digitally Challenged. So this is going to be our guide to making tax digital. So I'm going to start off with a little about myself. I specialise in tax disputes and resolutions. I've had over 20 years experience in advising individuals and businesses on their own tax affairs. I head up Hayes McIntyre's tax disputes and resolutions team, dealing with COP 8 and COP 9 cases, disputes with HMRC covering all taxes, negotiating settlements, voluntary disclosures and time to pay arrangements. With a wealth of experience guiding clients through what can be sometimes a very distressing time, we hold their hands, we keep them fully informed, negotiating the time to pay arrangements for them, and ultimately just agreeing the best possible outcome to achieve the client's goals, whether that's going to be a quick settlement, arguing what can be perceived as grey areas, reducing penalties, and in some cases there's going to be zero penalties or hopefully suspension, negotiating time to pay arrangements, and what can be liabilities ranging from thousands of pounds to hundreds of thousands of pounds or millions of pounds. All of this helps our clients sleep at night. I'm now going to hand you over to Richard to give an introduction for himself.
Thank you, Danielle. My name's Richard, despite how it's spelt. My background includes working on the dark side. I worked at HMRC for over 5 years in compliance roles, including 3 years in HMRC's Fraud Investigation Service, which is their top civil compliance team. Whilst there, I worked a range of cases, including fraud cases, Code of Practice 8 and 9 inquiries, with a focus on offshore matters, including LDF disclosures, and also challenging bespoke avoidance structures. Since seeing the light, I've now worked in private practice for 4 years, joining Hayes McIntyre's tax disputes and resolutions team almost a year ago from another top 20 accountancy firm. Whilst in the private sector, I've undertaken similar work to when at HMRC, just on the other side of the fence. I've been able to use my experience and knowledge of HMRC powers and processes to help clients negotiate inquiries, including Code of Practice 9 fraud inquiries, making disclosures of all types of tax, and also assisting clients with settlements in relation to avoidance. My particular strengths are helping clients achieve the best results with regards to penalty negotiations and also challenging HMRC assessments and assessing time limits. I'll now hand back to Danielle to start this afternoon's session.
Okay, if we could just, before that, so thank you for those very off-the-cuff introductions. If we could have questions throughout in the usual manner, that would be great in the questions box. As ever, they are expert speakers. They have stressed no question is too difficult or too complex, so please ask away. We will, as usual, be sending around a copy of the slides after the presentation. So without further ado, I'll hand over to Danielle.
Thanks so much, Kevin. So making tax digital for income tax is going to come into effect in April 2024. Now, this is going to be a fundamental change for the way that income tax and capital gains tax are reported for individuals and those predominantly with rental income and self-employment income. HMRC have sold making tax digital as a way of filling the tax gap, but also making it easier for customers to complete their reporting duties more easily, efficiently, and more cost effectively. So this afternoon, we're going to be covering an overview of making tax digital, the here and now, and the future. What it means, both in practice for clients and accountants, making tax digital in practice, so some feedback we've got from our VAT guys, problem areas that we're likely to encounter, together with the future of MTD. So the history of making tax digital, the past and the present. Some of you may recall that self-assessment was first introduced back in 1996. Since then, nothing has really changed. We thought it'd be useful just to provide you with an overview of the history of making tax digital, especially as it's been mentioned for so many years with a number of delays, the original implementation dates. Making Tax Digital was originally announced back in 2015 budget. I was going to say 19. So we've had over 7 years of discussing MTD. No wonder it feels like such a long time. The implementation dates for the introduction of MTD has been delayed across all taxes. You'll recall back in April 2019, Making Tax Digital commenced for VAT businesses that were registered over the VAT threshold. A couple of months ago, so in April 22, Making Tax Digital for VAT was extended to all VAT registered businesses. So looking to the future, April 2024, Making Tax Digital for income tax self-assessment individuals. This is going to cover those who are self-employed and or have property income over £10,000. They're going to be required to file Making Tax Digital returns. There may be some work required for those who do not have a tax basis period in line with the tax year end of the 5th of April. For those that are not aligned with the tax year, there's going to be a transitional year from 23-24. Now that's only a year away, so that's why we want to give you a heads up today and give you some of the key issues and the work that's going to be required. From April 2025, Making Tax Digital will be implemented for most partnerships. Now that's going to exclude LLPs and partnerships with non-natural partners, i.e. a corporate member. The date for the implementation of these entities is still to be announced, so let's watch this space there. April 2026, and I'm going to say at the earliest, MTD for corporation tax. It was due to be implemented. Now, I see this as the earliest of 2026, just to see what the perceived success is with the introduction of income tax and any teething problems that are going to be encountered. I'm now going to hand you over to Richard.
Thanks, Danielle. As Danielle mentioned, there's not been much change since the introduction of self-assessment, so we're going to run through what MTD is. From April 2024 for qualifying individuals and from April 2025 for qualifying partnerships, HMRC will require the submission of 4 quarterly updates. Along with an end of period statement, as well as keeping digital records. HMRC has stated that MTD aims to tackle the part of the tax gap caused by error and failure to take reasonable care. This is by removing opportunities for taxpayers to make certain types of mistakes when preparing and submitting their tax returns on a more frequent basis. And this gives more opportunity for HMRC to identify issues and intervene. It does not change businesses' tax liability or payment obligations, but it reduces the scope for error and allows for better guidance through digital prompts and nudges, as we have seen recently. Balancing payments will continue to be due on 31st of January and payments on account continue to be payable on 31st of January and 31st of July. From April 2024, unincorporated businesses and individuals, and from April 2025, general partnerships are eligible for MTD. That is individuals, businesses or partnerships which have a gross trading income of over £10,000 per year or gross rental income, whether that be a combination of UK or foreign income over £10,000 or a combination of the two, combined gross trading and rental income of over £10,000. To confirm, that's per taxpayer. So if you have a husband and wife with joint rental property that rents out at £1,000 per month or £12,000 per year, that will be below the £10,000 per taxpayer threshold, and they will each not fall into the MTD scope initially. If you're a member of a partnership, you'll only be required to file for MTD if you have an MTD source yourself. For instance, if you have a partnership with gross trading income of £100,000 a year with 2 partners and only one of those partners has partnership profit and the other one has the partnership profits together with a separate rental property that rents out at £1,000 a month, the partnership itself will file under MTD from April 2025 and the partner with the separate rental income of £1,000 per month will file personally before this from April 2024. There are currently no set dates for the introduction of MTD for partnerships with corporate members, limited liability partnerships and limited partnerships, trusts, estates, pension schemes and non-resident companies.
We've got a question there from Alice. Thank you, Alice. About the LLPs, do you foresee that they will escape MTD or is it just a matter of time?
It's a matter of time. Everyone's going to be in at some point. It's just when is that point.
Okay, thanks.
Interestingly, you can sign up early for MTD in some very limited circumstances. This was originally supposed to be available now, but this has reportedly been pushed back to 6th of April 2023, now that MTD for income tax itself has been delayed until April 2024. You can voluntarily sign up for the service if all of the following apply, and they are: you're a UK resident, you're already registered for self-assessment, your accounting period aligns to the tax year, so 6th of April to 5th of April, you've submitted at least one self-assessment tax return previously, you are keeping digital records, and one or more of the following were included in your last return: an existing self-employment source, a UK property source, or a foreign property source. So aligning with the rules that actually qualify you for MTD. And also you're up to date with your tax records, so you have no outstanding tax liabilities or returns. You cannot sign up yet if you need to report income from any other sources other than those that I mentioned earlier. You have an income tax charge, for example, high income child benefit charges or certain pension tax charges. You have a payment arrangement existing with HMRC. You don't have an up-to-date address registered with HMRC. You're a partner in a partnership. You are currently or going to be bankrupt or insolvent, or you're a minister of religion, a Lloyd's underwriter, or a foster carer. You have a third-party capacitor, and this includes trusted helpers, insolvency practitioners, nominees, or solicitors.
Okay, we have a question from Philip. Thank you, Philip. If Form 17 election is made with 100% to one spouse, then surely the 10k limit will apply to that spouse. So a 19k rental income under Form 17 would result in an MTD compliance.
I would have thought so. I can't see why not, because they have the legal ownership.
That one spouse would have over 10,000, so they would fall within the limit.
Okay, thank you. On from Robert. Thanks, Robert. Will the adjustment to align with tax year have to be 6th of April, or will 31st of March still be acceptable?
31st of March will be acceptable.
Right, okay, thank you.
There are also very limited exceptions to MTD, so those who will not be required to make MTD filings include those who are technologically challenged, and this might be because of age, disability, religion, whose beliefs are incompatible with using electronic communications and keeping electronic records. This isn't automatic, it's on a case-by-case basis, and you'd need to apply for an exemption. And also, if the reason for your exemption no longer applies, you must tell HMRC within 3 months.
So question there is, how do you apply for an exemption? What's the practical approach?
Like most things with MTD, we've still got to wait to see actually how it's going to happen, but that's what's been written down now for the actual application.
Right, so they haven't set it yet?
No,
okay.
It's not.
Okay.
So what will the filing requirements be? Quarterly submissions. These will run through the tax year, from beginning of the tax year through to the end of the tax year. For example, the tax year commences on 6th of April, so the first quarterly submission will be for the period 6th of April 2024 through to 5th of July 2024. Historically, we're used to a long filing deadline. The new filing deadlines will only be 1 month after the period ends, so this is a much quicker turnaround than what we've been used to, and it's important to note that you're not caught out. An example of what is reported on these quarterly submissions: so someone with rental income, they'd be required to report the first 3 months of rent received in the period, along with all the expenses incurred during the period, which might include home insurance, mortgage interest, and other usual expenses. And for a self-employed individual, they'd be required to report all the 3 months sales or income in the period, as well as costs such as salaries and cost of sales, and so on.
A question there from Tom. Thanks, Tom. Will everyone have the same reporting quarter?
So the answer to that is yes. There's no staggering of quarters. Everyone will have the same quarter.
Thank you.
As well as the 4 quarterly submissions, there'll be an end of period statement with a 31st of January filing deadline, and this will replace the tax return. The end of period statement will introduce all the other sources of income that the individual has during the year, and for example, employment income, capital gains, portfolio interest, as well as adjusting for the figures reported in the quarterly submissions if necessary. Other period adjustments that may be necessary could be capital allowances, interest, accruals, or dividends. For individuals who don't fall within MTD, for instance, their rental income or self-employment turnover is below £10,000, their self-assessment filing process will continue as normal. And once within MTD, in order to get out of the obligation, an individual would need to file 3 consecutive tax years of being below the threshold.
Okay, I have a quick question here on the exemptions that you mentioned on the previous slide. You mentioned that a list of various criteria. We talked about the ability to exempt out. Have they set any guidelines? For example, if you're a technophobe, what counts as a technophobe? You know, for example, and if they deny it, will there be a right of appeal, or have they issued such things yet?
They haven't released the guidance on that yet. They've just given the examples of someone who's maybe prevented by age, so that may be that they don't have a computer or they can't work it, their religion, their religious beliefs, or their disability, but it is on a case-by-case basis. So it would be a discussion with HMRC and approved or denied on that basis.
Okay, but there's no sign yet of an appeals process or anything like that as yet?
No, that hasn't been mentioned.
Thank you, guys. Question for Andrew. Is reporting by total or on a transactional basis? On an all transaction basis? Is reporting by total or on an all transaction basis?
We will come on to that in a moment.
Okay.
It's to do with the software.
Okay. Will the quarterly returns be done on a cash basis, or will they include annual adjustments such as debtors, prepayments, etc.?
So that the adjustments would come in at the end of period statement in January.
Okay, thank you. One from Nick. Thanks, Nick. In order to meet these deadlines, I will need to employ 2 additional members of staff, but this cost isn't possible to pass on to the client. Not only do we have quarterly tax returns to complete in the year, but also the 22, 3 and 4 tax returns for all clients. How do HMRC expect returns to be filed on time? Surely there should be an extension to submit the 23, 24 tax returns. Has there been anything regarding the deadline extension to file this return?
There hasn't been. We will come on to a little bit more detail about some grace periods in a moment, but no sign of extensions yet.
Okay, I guess this is a comment as much as anything from Sabir. Under the Taxpayers Charter, which has a statutory footing under Section 16A CRCA 2005, states HMRC should be making things easy. How is MTD consistent with the Taxpayers Charter?
I think ultimately, the ultimate goal is it will make things simpler, but it's that transition period we're going through.
Will ministers of religion file MTD using the self-employed pages, or do they have the Minister of Religion supplementary pages as currently in self-assessment?
We haven't seen anything yet, and yeah, they're still working with software providers. We'll see what happens there.
So it seems there's quite a bit still up in the air then, isn't there? So lastly, before we move on, we have a client who is a judge and currently files paper returns. Will this change with MTD?
So we believe there may need to be an exemption for some groups from the trading and property income MTD income tax quarterly reporting, and this is taxpayers dealt with by Public Department 1, for example, judges and MPs. Again, no guidance has been provided yet in relation to these individuals.
Okay, great. Thanks very much.
So to ensure that you're ready, what you can do is set up separate bank accounts so that when it comes to quarterly submissions, you aren't looking at various different sources for this information. It should all be within one place for your own convenience and to minimise mistakes. To get ready for MTD and the quarterly submissions, try to keep your records on a more live basis, whether that's quarterly or monthly, in order to get into the rhythm of doing this, and that will help because obviously you've got 1 month filing deadline from the end of the quarters, and that's a big change from what we're used to. And for self-assessment individuals who are filing MTD for VAT, it may be worth aligning your VAT periods with the quarterly submissions, and this will help on the ease of administration. Otherwise, maybe an extreme example, but you may only end up with 4 months a year where you aren't making submissions to HMRC if you don't align them. As professional advisors, we're looking into this so we can best advise our clients. Due to delays, software providers haven't had the confirmation from HMRC in terms of requirements and therefore what MTD will look like in terms of the actual software they're going to provide. Because of that, they haven't really come to market with their offerings for MTD, but we're going to keep an eye on this. Over the coming months, we expect that to progress, and we'll be liaising with them in order to provide further practical suggestions and recommendations for our clients. At present, there isn't any approved MTD compliance software for income tax. Past experience, being the introduction of auto-enrolment, showed us there are a number of delays before the software providers could roll out their supporting software. One would hope this isn't going to happen with MTD, and the HMRC will leave enough time for people to make informed choices about their software with no time pressure rushing at the end. We're constantly keeping up to date with any HMRC guidance in terms of any changes to MTD, and we're publicising this across all our platforms. Make sure you're subscribed to keep abreast of these. Our client offering will follow once agreed with software providers, and we have more insight as to what it will look like from their end. Coming with MTD is basis period reform, and this technically comes in from April 2023, and this year 2023 to 24 will be the transitional year, as Danielle mentioned. As an example, if an individual had an accounting period of 30th of June for the 2021 tax year, they were taxed on the accounting period that fell within the tax year. So this would be profits to 30th of June 2020, as that falls between 6th of April 2020 and 5th of April 2021. HMRC have proposed to change the way accounting profits are taxed from what's known as the current year basis to a tax year basis. Irrelevant of what your accounting period is, you're going to be taxed on the profits and the loss for the tax year. From April 2024, you'll be taxed on the profits for 6th of April 2024 through to 5th of April 2025. The transitional year will be the 23-24 tax year. Using 30th of June year end as an example, if in the 2023-24 tax year, along with the accounting profits for the year end to 30th of June 2023, as that falls within the tax year 23-24, the individual will also be taxed on the profits from 1st of July through to 5th of April. As you can see from the example on the slide, and this is deliberately an extreme example, the individual is taxed on the profits of 30th of April 2023, plus their profits from 1st of May to 5th of April. During this period, the individual is taxed on 23 months worth of profits, which means more profits leading to an increased tax liability. Due to the change in rules, the individual will be able to utilise what is known as overlap profits. These are profits that have already been taxed. However, given the nature of business, it's unlikely that the overlap profits are to the same level of the additional profits that will be brought into charge for the year. Therefore, in that transitional year, it's likely that the self-employment profits are going to be a lot higher than normal. And then subsequently, the tax liabilities are also going to be higher, and this could put a strain on finances and cash flow. This treatment's applied irrelevant whether an individual changes their accounting period, with overlap profits being brought into charge. HMRC are allowing individuals to, on a case-by-case basis, prorate that additional profit. So in the example shown, the period of 1st of May 23 through to 5th of April 24, net of the overlap profit that's available, and split that over up to 5 tax years. This is an election which needs to be made. The automatic position is that all profits will be brought into charge in 1 year, which is the transitional year. To qualify, a trader needs to transition in 2023-24. He cannot do so early and benefit from splitting the profits. A business can be flexible when the spread profits are brought into charge and can elect to bring them in earlier than an equal split over 5 years. For example, if the business has higher capital expenditure in a tax year and qualifies for the AIA, it could bring in additional profits for that year to be relieved. The risk with electing for this treatment are that profits could be spread and intended to be brought in over 5 years, but the business grows and becomes much more profitable in future years, and therefore these additional spread profits are taxed at a higher rate of tax. Historically, we've had a lot of individuals with a year end of 30th of April. The reason for that was, in effect, in the opening years, it deferred your large tax bill even to the subsequent year. It's your client's decision whether they change their accounting year end. If there's no commercial reason not to, we would strongly recommend that in order to reduce administration, it's probably beneficial to change to a 5th of April year end. Using a 30th of September year end as an example, this is exactly halfway through the tax year. You'll be taking 6 months profits from 2 accounting periods, and due to the nature of timing and accounting, it's extremely likely that when you're filing tax return and end of period statements, the figures for the later accounting period have not yet been finalised. You may have to submit provisional returns and then subsequent final returns once those figures have been finalised, so you're duplicating the administration. For ease of admin and to reduce that burden, unless there's a commercial reason, it's probably more beneficial to change that year end. You're only completing 1 set of accounts for that end of period statement that way.
Okay, we'll move on from that. Question from Peter. Can the year end be changed during the year ended 5th of April 23?
That is the transitional
year.
year.
It has to be changed in that year.
It has to be changed.
That is the transitional year.
Okay, good. One from Claire. How do transitional profits interact with other tax reliefs and allowances if spread over multiple tax years? So I'll read that again for our listeners. How do the transitional profits interact with other tax reliefs and allowances if spread over multiple tax years?
So this is a bit of a technical one. Transition profits will be separated out in the tax calculations as an extra component of income. So they won't affect the level of a taxpayer's net income used to calculate the pension annual allowance charge. And the additional profits do not impact on the high income child benefit tax charge. But any relevant deductions at step 2 of the pro forma income tax calculation can be used to reduce the transition profits. But this could also result in the personal allowance being tapered if the profits are high enough.
Okay, thank you. Walter asks, what will HMRC do with the information submitted quarterly? Are they going to review it? What are they going to do with it?
So we do cover this in a bit more detail later on.
Okay, come back to that then. Thanks, Walter. If HMRC are keeping the tax payment dates the same, why do they need the information in quarterly?
So we also cover this a bit later on. We don't have a definitive answer for that, but we'll give our opinion on that later on.
Okay. Okay, thank you.
So onto MTD penalties. There are new penalty regimes for both late filing and late payment of tax under MTD. From April 2024, HMRC will introduce a brand new points-based system for late filing, and this will be a bit like the driving license point system. You might already be familiar with this if you like driving really quickly. It will penalise serial late filers and late payers, and this has been introduced to VAT from April 2023. As there will potentially be 5 submissions a year to HMRC, the penalty points could really add up quickly. So the late filing penalty regime, you receive a point every time a submission is missed. Once relevant thresholds are reached, a financial penalty of £200 is charged, and a further £200 will be charged for every subsequent failure, but no further points are accumulated once you start incurring fines. The points totals that you can see on the screen depend on how frequently you're required to submit returns, and these are 2 points for annual returns, 4 points for quarterly returns, and 5 points for monthly returns.
Okay, on that one, a quick question we have from Ramisa. You mentioned there the thresholds, so 1 point for each late return. Are we therefore suggesting that under Making Tax Digital, if you're inside Making Tax Digital, you can submit 1 return late and not get a penalty, and yet if you're not in Making Tax Digital, like many of us aren't, then you're going to get that £100 fine regardless?
Yes.
That's very fair and reasonable. Yeah, okay, thank you. Last, is there any penalty mitigation, like reasonable care and that type of thing?
So we do cover this. There is reasonable care, but we'll cover it in a bit more detail.
So before we move on, we've got a question from Richard. I appreciate transitional profits can be claimed over a maximum of 5 years. Does this mean that a minimum of 20% must be claimed each year until the profits are exhausted?
That's the automatic basis. So if you were to spread it over 5 years, but you can elect to change the amounts that are brought into each year, as we mentioned, depending on what your forecasts are.
Are there time limits for those elections?
23, 24 is when the transitional year is.
Okay, great, thank you.
So the points total remains separate for each obligation. So this means there's separate totals for income tax and VAT. Points that you receive have a lifetime of 2 years, and after this they expire, although the expiration does not apply where a threshold has been reached. A period of good compliance must be achieved in order to reset a points total. For points to expire, an individual needs to meet 2 conditions. So the first one is a period of good compliance. So you can see this, the condition 1 on the screen. The period of good compliance relates to how frequently you're required to submit returns. So for annual returns, 24 months, for quarterly returns, 12 months, and monthly 6 months. So that's a period of good compliance. All obligations are met on time. And the second condition, all filing obligations in the preceding 24 months have been fulfilled, whether or not they were initially late. So a combination of the two need to be met to equal good compliance and reset points total. Just to run through that again, that's 24 months of all submissions met, whether late or not, and then in addition, a period of good compliance submissions on time as per the table shown. So that's not the easiest one to understand. And just like with assessments of tax, HMRC have time limits to levy a point, after which once the time limit's expired, HMRC cannot levy a point. So they have 48 weeks for annual returns, 11 weeks for quarterly returns, and 2 weeks for monthly returns. And HMRC have 2 years after a failure within which to assess a financial penalty if that applies and a threshold's been met. And to go on to a question that Kevin raised earlier, an individual can challenge a point or penalty by appealing to HMRC or an appeal to the first tier tribunal as may be necessary. The main grounds to appeal is on the basis of a reasonable excuse. The process is much the same as for existing late filing penalties, but in our experience, HMRC set a really high bar for reasonable excuses, and they expect a reasonable excuse to apply in only really extreme circumstances. There's a separate regime for late payment, and Schedule 56 Finance Act 2009 is now being replaced by a new penalty regime. There's no late payment penalty if the taxpayer pays the tax late, but within 15 days of the due date. The first penalty is set at 2% of the outstanding amount if they pay between 16 days and 30 days after the due date. If there's any tax left unpaid 30 days after the due date, it's set at 2% of the outstanding amount at day 15 plus 2% of the outstanding amount at day 30. In most cases, this would amount to a 4% charge at day 30 unless a partial payment is made between day 15 and 30. A second late payment penalty is charged at a rate of 4% per annum, charged on a daily basis on the total unpaid tax incurred from day 31. So a simple example just to illustrate that, if you paid the tax 1 year and 1 month late, you'd be subject to the full first penalty of 4% for the first 30 days and a second penalty of 4% for the full year. To avoid a penalty or penalties, the taxpayer will either need to pay or approach HMRC to agree a time to pay arrangement in advance of the due date. There was a light touch with regards to penalties for VAT. This has now ended. In the first years of income tax self-assessment, HMRC do recognise that moving to the new system of late payment penalties, significant change for some taxpayers, understanding the new filing, the new payment, and also the penalties. And this is especially prevalent for those who might have difficulty in getting in contact with HMRC within 15 days. HMRC will introduce a light touch approach to the initial 2% late payment penalty. This is only in the first year of operation, and this is both VAT and income tax. In the first year, HMRC will not assess the first penalty at 2% after 15 days. So in effect, this will allow taxpayers 30 days to approach HMRC before HMRC charges a penalty.
Okay, you mentioned in there about the possibility of paying a partial payment. Are you suggesting that if you make a partial payment, that will stop a penalty?
No, you'd still be subject to the first 15%, but obviously not in year one.
Yeah.
You'd still be subject to the first, at day 15, you'd be subject to the first 2%, but you'd avoid the second part of the first penalty of 2%.
Just by making a partial payment?
Only on that partial payment that's made.
Only on the partial payment, right, okay.
Yes.
And there's also a further and really harsh penalty, and this is failure to use functional VAT MTD compatible software. And HMRC would charge a penalty of up to £400 for every return you file just for not using the appropriate software, and we also expect this to extend to income tax MTD. I'll now hand you back to Danielle.
Thanks ever so much, Richard. So I'm going to cover MTD in practice. So we've spoken with our VAT colleagues to obtain practical feedback on what MTD from a VAT perspective has looked like. So the general feedback has been that the transition to MTD has been very smooth, but VAT was always going to be the easier transition, mainly because VAT quarterly returns existed prior to MTD, with both individuals and businesses filing on a quarterly submission basis anyway. Some software providers have produced quality VAT MTD compliant software. We haven't tried them all, but what we do know is that Xero has worked very well. There have been some clients who do not wish to change the way they maintain their business records and continue to use Excel, for instance. This is in addition to clients who have partial exemption calculations. Our VAT team have found it easier to prepare the calculation in Excel and submit this to HMRC using a bridging software. Notably, MTD for VAT is still new, so both of these may change over time. There are a number of bridging software providers which enable the use of Excel to be facilitated for MTD purposes. Some of the software providers on the market are free. How good the software is and how trusted the providers are, and I think in the back of my mind had the use of the data, we just don't know, and it wouldn't be something that I would use personally. In terms of costings, the use of bridging softwares may not always be the cheapest option. With the introduction of MTD, for those who do not already use MTD compliant software, now might be the time to start looking at software providers. We're in the digital world and change is going to be inevitable. Digital record keeping is mandated via primary legislation. And supplemented by secondary legislation, with penalties of up to £3,000 to be applied for the failure to comply with digital record keeping requirements. The requirements for the timelines of the retention of documents hasn't changed, but one thing to bear in mind is when using digital software providers, and from experience with clients, a taxpayer is only going to be able to access their digital information if they continue their subscription with the software provider. So if you're thinking of changing provider, it is something that you should consider and discuss with the provider before making the transition. Outside of MTD, but something that's worth considering with the points-based penalties coming into play, and the easy thing to do is setting up VAT payments by direct debit. Making the payments in this way reduces any unnecessary defaults and removing another of those calendar reminders that we all have. A more automated process is going to assist with timely payments. One very important thing to remember, and it was the first thing that I ever learned when studying IT, garbage in, garbage out. Professional assistance remains a valuable investment for all taxpayers. Incorrect filings of returns can prove costly, not only with penalties, but also interest. The rates are continuing to rise, with currently having a rate of 3.5%, which we know in the next few weeks is going up to 3.75%.
Okay, so we've got a question there from Angela. Can you give, obviously we're not going to recommend a particular provider, but can you give any tips for the sort of things you should look for when selecting someone that you can recommend to clients?
It is something else I'm going to talk about in a minute, but I think every single taxpayer has unique and individual needs. And so it would be remiss of me to say, yes, go with one provider, because not one provider suits everybody.
Yeah.
So I think you just need to look at what the taxpayer needs and then have a look at what the provider actually offers to see if it's a right fit.
Okay, and what sort of things should they be looking for?
Thinking about someone who's just got, say, one rental property, do they need to buy a full zero package that offers all of the bells and whistles? No, unlikely. So they're the sorts of things I think you need to be looking out for.
Okay. From Andrew, thank you. How do you get through to HMRC by phone within 30 days?
My recommendation there is always to phone them at 8 o'clock in the morning. I have to say, early calls with HMRC, you are normally through within 5 to 10 minutes. Personal experience, trying to phone them anytime after lunchtime, you may as well give up.
Thank you.
So problem areas. MTD filings are going to be more frequent for income tax and corporation tax, from the annual filings that we're used to quarterly filings. This in turn is going to require taxpayers to keep digital records up to date. The associated cost with this is not just financial, but it's the time costs that are going to be involved. Financial in terms of the software, additional professional fees for the additional filings, and the time commitment of actually sourcing and implementing the new software to accommodate MTD, and taking into account the 5 submissions compared to the previous 1. We have seen a number of software providers taking advantage of MTD to sell various digital software. People having acquired software following a marketing campaign and it's just not what the individual requires. So I think the takeaway is always to contact a professional advisor in the first instance before acquiring any unnecessary, costly software. We don't want clients to be upsold complicated software. It's too expensive and far too sophisticated for their needs. One example, one of our colleagues' mothers said that she plans to provide a full Xero suite package on a monthly subscription that she's seeing marketed. However, her affairs are simple. She's got one rental property and no other income. So this may be excessive for her and quite costly. So cash flow may be affected for a number of businesses that are going to be required to change their basis periods, with potential super profits coming into charge if they don't act now. It's essential to look at the basis periods and potential profits, undertaking some cash planning, as well as possible future exposure to the top rate of tax. The new penalty regime is also to be understood by everyone. We're going to need an education exercise to all taxpayers, especially those taxpayers who are used to paying their tax 29 days late. So some predictions for the future. Mystic Meg processes. HMRC will further automate their risk review process, so using their Connect system. They could bring the payment deadlines in line with the filing deadlines. Whilst the late payment penalties Richard discussed earlier may actually appear cheaper to the current rates, if HMRC were to move to 4 payment dates, this would mean the entire tax liability could be subject to late payment penalties, and therefore much more expensive if the payments are paid late. On the face of it, the penalties seem more generous, but I think this could be gearing us up for quarterly payments in the future. Due to the delays in introducing MTD, it's likely that this is going to be a long, long way off. We recommend for all clients to be proactive with the introduction of MTD rather than reactive. First things first, let's try to get them used to keeping up-to-date records. From a compliance perspective, once MTD is in full swing, HMRC will have up-to-date information at their fingertips. I believe this will link through to additional inquiries, as there will be greater visibility on the submissions to HMRC. That, combined with the third-party filing requirements, the exchange of information between governments, the use of the Connect system, and additional HMRC resource. MTD inquiry periods, we understand that these aren't going to change. However, HMRC will have 3 more opportunities to inquire each tax year. Our VAT colleagues have noted an increase with the use of the smaller compliance checks into quarterly returns rather than full-blown inquiries. We expect we may see this as a similar approach coming through for MTD for income tax, with more opportunities for HMRC to undertake a check together with certain transactions, for example, capital gains, being magnified on a smaller return. Overpayment relief claims, this isn't going to change and is going to be in line with what we currently know.
Okay, so we've got a question on the compliance checks. Will they be into quarterly or annual returns?
I think they will be into quarterly returns.
Okay. You mentioned right at the beginning about CGT. How will that work with MTD?
So at the moment, it's not coming in 2024, but it will come in as things progress.
Right. Okay. Do you think there will be clients who will be tempted to prepare their own quarterly returns for maybe 3 quarters of the year and then get their accountants to do the final return?
Potentially,
make adjustments.
But they would need the software because obviously, as we discussed, there's the £400 penalty for every. So they're not really going to be saving any money and potentially getting it wrong 3 times a year.
Okay.
Right once.
Okay, great. If a business is already filing VAT returns under Making Tax Digital, do they also have to file a further quarterly return for income tax?
Depending on their sources of income. But yes, yeah.
But for the same source, for the business.
Yeah.
You're trading and making candy floss, and you're making your VAT returns. Do you then need to make a separate one for IT?
Yes.
Yes.
If you're above the thresholds.
So much the same as you do now.
Exactly.
Yeah, and like we recommended, we'd recommend bringing if you've got kind of VAT on a stagger, we'd recommend aligning them.
Okay, right, thank you.
Okay, that's going to leave me then just to sum up today. So MTD is going to create huge changes ahead for all of us. So let's just start thinking about it now and what we're going to do. MTD corporation tax is coming. We're all going to be in at some point. We just don't quite know when. Income tax is going to commence for rental profits and self-employment income from April 24. You can see how easily this is going to be expanded to include other forms of income in terms of investment income, and that's probably going to be their next choice. There's no plan at the moment to change the income tax payment dates, but it is likely to be attractive for HMRC. So let's see what happens there. As previously mentioned, cash flow may be an issue initially, with the changes to the accounting dates and the profits that are going to be brought into charge. So following on from this transition, if you're likely to need a time to pay arrangement, we know that HMRC have recently been very pragmatic. This is on the back of COVID, but we do expect this to change. So my recommendation is to be proactive now and actually start thinking about how you're going to deal with the tax falling on the profits coming into charge. No doubt about it, it's going to be challenging, especially with the new penalty regimes, with more opportunities for everybody to fall foul. Should you require any assistance under the new penalty regime or the current one, Rich and I will be more than happy to help. Thank you for all your time this afternoon. Thank you, Kevin.
Thank you. A couple more questions. How can a return be filed if the software is not compatible?
It will have to be. So the MTD software will be released, will have to be released beforehand.
But the onus, I guess, is on the client, the taxpayer, to make sure that it's compatible.
Yes.
Nobody else, yeah. Okay, what level of detail will need to be included in the quarterly returns, particularly of expenses? So I guess the question there from Robert is, are we expecting, in effect, the equivalent of full annual returns, just 3 months?
No, for instance, if we think about it, a mortgage interest statement, that's normally available on an annual basis. So that's going to form part of the end of period statement. And so that's where the adjustments will come in. So that wouldn't form as part of your deductions unless it's readily available when you're doing the quarterly submissions.
It would be the quarterly submissions would be as much information as you have available at that time. So it would in effect be for kind of annual returns on a quarterly basis. But then, like Danielle said, with the adjustments at the year end for information that you didn't have at the time.
So you mentioned earlier, and I've had a couple of comments on this, about whether or not we can expect quarterly payments to follow this in a similar way, I guess, that we've seen CGT payments brought forward. Do you think, just an opinion here, do you think this is what's on the horizon?
I think it's inevitable. Just looking at the penalties at the moment, you just think, well, actually it's cheaper, this is great. But it just leads me to believe they're going to bring in the quarterly payments, because then it wouldn't be cheaper than what we've currently got now.
Okay, well, thank you for that. As I mentioned earlier, we will be sending around a copy of the slides. We'll have a listen to the recording, and if it's coming out well enough, we'll let you have that too. Meanwhile, I'll thank Danielle and Richard for coming along today and presenting their webinar. It is one of our monthly webinars to our client member firms and selected guests. From the comments we've got, I can see that many people have found it very useful. So Danielle, Richard, if you'd like to say your goodbyes.
Thank you very much.
And we will catch up with you soon. Goodbye, and thank you for listening.